Good evening. This is Duane Lowry for the DPP Grain Desk on Sunday, January 6th. It's a little bit later than normal. What is it? It's just a few minutes after 5. The market's opened already tonight, so I'm a little bit late getting this video out. The calls were basically mixed. Some looking for a little better, some looking for a little weaker. There wasn't anything significant. Basically, you had the bear camp would talk about poor price action we had of late, talk about generally favorable South American weather, talk about Friday's Informa data, and Friday's weak price action, and by the default, a lot of people were looking for weakness. I think on the bull side argument, you've got the idea that markets are oversold. Whatever bearish factors we've been using as excuses for this recent weakness have largely been discounted. South American weather has been labeled as neutral or favorable, acceptable for quite some time, which I think in general terms is probably an accurate assessment, but it reaches a point once that the market digests that. It's also fair to say you've got problems in northeastern Brazil. You've got other pockets of problems. You've got some people concerned that portions of Argentina have too dry of a forecast in their outlook. And I'm sure if you're a Southern Brazil, or excuse me, a South American producer in northeastern Brazil, you're probably sick and tired of hearing about how generally benign the weather forecasts are. Those areas have been hurt pretty hard, and the marketplace has had no impact. The other factors that the bulls are going to be looking at are oversold technical conditions, ideas that in the case of wheat especially, the cash markets in the U.S., the global prices, the U.S. wheat price in relationship to global values is just extremely difficult to justify the last 40 cents down in Chicago wheat futures. I think there's an argument that can be made that the USDA reports on Friday could have some bearish implications about large U.S. soft red winter wheat acreage, but you've still got a hard red winter wheat crop in the plains that went into dormancy in one of the worst conditions in modern history, and you've also got a situation where soil moisture profiles have not been dramatically changed by any moisture events that have occurred this winter. You've got other people talking about longer-term weather forecasts that offer, some reasons to be concerned. So when you look at global wheat values stabilizing or still firm or finding difficult to get offers, and then you see U.S. wheat, largely the cheapest wheat in the world, certainly cheap in relationship to normal competitors, it makes you wonder how can the wheat futures continue to stretch this rubber band of reality to the extremes that we are at the present time. At some point in time, you would think there's going to be some sort of snapback recovery type of rally. With a big report due out on Friday, the oversold technical conditions, the global wheat priced relationships and versus futures being stretched here, and the U.S. extremely competitive in the global arena, you would think that it's not unreasonable to expect some short covering activity there this week. If you look at intermarket spreads, wheat's cheap versus corn historically. When you look at corn, corn has its own reasons to suggest there are better prices ahead of us. Charts look troubling, I understand that, but we got some oversold conditions. You've got tight U.S. Corn stocks. So what if Informa says there's 75 million bushels more than what the USDA gave us for their last assessment? 75 million bushels is not significant. That makes no statement about what demand has been like during the first quarter. I think prices have been better, or excuse me, cheaper than what most feeders expected, and I think that you've had offtake and usage in the first quarter this year that should prove to be at the high end of expectations. That would tend to make U.S. stocks in the months ahead tight and more of a market talking point. I think you've also got a situation there now that U.S. corn offers have diminishing competitive offers from other suppliers if you can find offers, and I think the outlook is much improved for U.S. corn exports down the road. If you look at the producer side of it, I think producers for multiple reasons, whether because they sold more than they thought because the crop was smaller than they expected, or whether they got nervous about fiscal cliff issues, or whether they were trying to adjust for fears of higher tax rates in the years ahead. There's a lot of people that feel that the U.S. producer has a relatively small inventory of unpriced old crop grain at the present time. I would tend to think that's probably true. I think there are mixed viewpoints on that in the cash market, but generally speaking, I think people feel that the farmer's already sold quite a bit. I think with the futures market down here, that means that the farmer is going to be very reluctant to make sales in the next 90 days. I think they're going to be anxious to see what their soil moisture profile looks like in the spring, and I think that unless the futures market stages a pretty significant corrective rally, say 50 cents or more, I think it's going to be very difficult to shake corn from the producer's hands. That's going to tend to make basis values firm, and eventually I think it's going to lead to a futures price recovery, especially since competing supplies for corn in the world are going to become much more difficult to find. The offers are being difficult to get, and I think you've got an improved prospect for U.S. corn exports here in the months ahead of us. So I think corn has got its own reasons to believe that there's some recovery here, and I don't think it's unreasonable to believe that it's possible it could be a pretty significant recovery. As far as soybeans are concerned, you've got the bears looking at large South American supply expectations. It's pretty tough to argue with that. We can talk about areas down there that have had problems, but as a general rule, so far, it looks like they're going to have a pretty good overall production and relatively plentiful global supplies. The problem is we've all seen times where it's difficult to get those supplies to the right location at the right time and get the offtake into the ships as quick as buyers would like. And I think that at the present time we've got a situation where there's a good chance that in the months ahead of us you're going to see U.S. source supplies once again have interest, especially with transportation bottlenecks out of South America. I also think you got a situation that despite China canceling some purchases over the last few weeks, their domestic crush margins are very favorable, and I think that the odds that they're going to be fairly aggressive in the global pricing market and buying, looking to import more beans, I think is good. And I think that you've got futures prices now down to a level that, one, they're technically oversold. Two, if you remember a week ago in the video when I talked about hopes that beans could hold and hopes that corn and wheat had merits to hold, but beans were troubling and they were concerning. They did warn of some downside risk. But in last week's trade, the market accomplished those downside risks, and I don't think you've got a lot more pressure that should come to bear here in the bean market. So there's a lot of reasons to think at worst we're trying to bottom here. The other factor that I think is important is this week, tonight, we begin what is the first full week of trading for 2013. Finally the holiday periods will be behind us, the shortened week, and things of this nature. China returns this week, and I think that there's a good chance the global buying activity and export activity and export sales activity interest is going to be picking up. So I think you've got quite a few things that are different. I think you also can't help but think that with Friday's USDA reports, markets oversold on the bottom side of parameters with USDA reports that certainly could hold some bullish surprises, especially in, say, first quarter corn feed use in the U.S. I think it could be some figures in the global wheat that reminds us that we still have to have a decent crop, and that U.S. wheat is cheaper in relationship to other origins that make you think you got limited downside. And yes, the South American crop figures are probably going to be bearish, but here again, I don't think there's any surprise there. The market's been digesting that for some time. So I think it's reasonable to believe that we can generate some type of short covering activity here this week, early this week after we get the reports. We'll see what we have got. But if you look beyond this week or beyond next week, look ahead 2-3 months down the road here, I think there's a good chance we're going to have better pricing opportunities ahead of us. I think it's fair to say that the producer should view the price weakness we've had in the last 30 days as a wake-up call to what can happen, and the fact that high prices, high profitability don't have to be here to stay, and there can be ups and downs to that, and we're due for a down for that. And I think that there's justification for a producer to think that he'd better have a sharp pencil for this next year, and he'd better be looking for forward pricing opportunities. I have no problem with that general concept, but I do believe that the price weakness we've had here in the last 30 days has become overdone to the downside, difficult to justify, especially when you look at wheat and corn. Maybe not so true in soybeans, but certainly true in wheat and corn. For the DPP Grain Desk, this has been Duane Lowry. Thank you.